Welcome back to Dear Rochester, Retire Well. Here's your host, Dave Pulcini, CFP.
Welcome back, folks. We have John Harms with us here today for a special episode. We are talking about investing during an election year. I'm going to take this hat off of the microphone so people can hear us. We'll throw that over there. Steve's going to wear our hat. John, I'm going to ask you one question and let you do your thing because people love it. Who should I vote for this year if I want the markets to go up in the next 4 years?
Okay, hitting me with the hard questions to start off. I definitely cover that. We'll get to there. But I think by the end of this, you should be able to figure out exactly who to vote for. But I have
what
to
a
tell
hook.
you.
The investment guy with the hook.
I have to tell you. I've been looking a lot at the platforms that are out there. I still haven't seen a candidate that will promise what I need for my vote.
What's that, John?
That is national holiday the day after the Super Bowl. Let's go. Okay.
Okay.
All right. So, we've been talking about doing this one for a while. I mean, it's an election year. We get tons of questions from clients, advisors. How do we invest in an election year? So hopefully this will give you a little bit of a guideline, kind of the way I think about it, what to look for. And really just to get out in front of this thing. We got 2.5 months left before the election. I mean, part of the year's already gone behind us. Yep. We're having a pretty good year so far. Recent little blip, but S&P 500's up over 17% for the year so far. So that's a really good year. But how do we make sure, we kind of protect ourselves in case this election is the big one, right? Mm-hmm. All right. So first, I just want to talk a little bit about history, what's actually happened. There is a really good chart out there. I've seen it thrown around a lot. We follow a lot of investment companies and fund managers. And this one really gives you a whole outlook of since 1933, FDR's first inauguration. There's 7 times a Democrat was president and 6 times a Republican was. All right. And in those times, if you invested $1,000, if you're lucky enough to have invested for 90 years, $1,000, you're up about $12 million right now. So really, you can pick any, I'd say, 30-year window on this chart, and it's going to be up over that 30 years. So kind of from a broad stroke perspective, we expect over long periods of time the market to be up. There are the shorter periods of time, and we like to look at elections as this is a time to gauge, what's the market going to do. So here's some average 10-year returns that the Capital Group put together. Republican, if you invested the start of their term, average 10-year annualized return was 9.8%, just under 10. Democrat was actually 10.7%. So not super far off. It's not like one was like, oh, man, I really shouldn't have invested during this term. If you look even closer, the last 3 presidents, if you annualize their returns, so President Obama, 16% annualized. So that's a pretty good return. Donald Trump, same thing, 16%. Joe Biden, 12% so far. So really, again, pretty good. That's above the long-term average. We're doing pretty good the last 3 presidents.
Yeah.
What else will we see? I would say one of the things that was striking to me, and I didn't realize it was quite this low, but during an election year, the average rate of return has only been 6.2%. Still up, still a positive year, but the average annual return for any year was 9.6 since that 1933. But that does include 2000. That was kind of the start of the tech bubble bursting. Next 2 years, September 11th, and then 2002 was also a very poor year. And then 2008, one of the worst years we've ever had in the market. So that definitely throws down the average, but it is of note. So we do want to kind of be cognizant of it. What else? We see higher volatility. So again, those 2 years are in that mix. So you're going to see higher volatility. It's about 10% more volatile in an election year than a non-election year. So I think you would probably expect something like that. But then it's like, what does the year actually look like? And we talked a little bit in the Q2 review, seasonality, kind of when we typically see stock market do well in a year and not, and every year is not the same, granted. But in election years, you usually see a pretty stagnant market or more volatility. It's actually early on in the year when the primaries are still going on. If you think about it, you've got uncertainty, right? Market hates uncertainty. Everybody says that, right? That's one of the most commonly uttered phrases on TV. So what's more uncertain than an election? I don't know. So once that uncertainty starts to clear up, and especially by the time the election comes, but even I'd say around June, I see in these charts, you definitely see the shape and the pattern of the market behave more like just a normal year. Okay, so kind of most of that volatility typically happens early on. And it hasn't really played out quite like that this year. Like I said, we've been up significantly. We did have a more recent kind of downturn, and there was a lot of factors at play. But the last time we talked, Joe Biden was the nominee, and now Kamala Harris is the nominee. So that's kind of a lot of stuff still to play out. 2.5 months left. We're right in the meat and potatoes of this thing.
Hey, real quick, the recent volatility thing. I know you put out a video on this. I want to relate this back to financial planning just for a second. Markets dropped quickly, which maybe you can explain why. And I know why, but I want you to explain why. And then a lot of people panicked immediately, saying, finally, now we're seeing this downturn. Now we're headed into the recession. And folks, investors, were immediately panicked, like they've been waiting for this to happen. And we talked about this a little bit before, but if you're waiting for that to happen and you're literally just panicked the moment a downturn happens, why are people invested in a way that's going to make them panic if they know it's inevitable?
So I definitely have a lot about this later on.
Okay.
I'm going to
keep saying that. I'm going to stop asking questions.
You, by the end of this, I'm literally going to give you a step-by-step. How do we survive this whole thing? So, I mean, there was a lot of reasons for what happened. Some of it was yen carry trade, which I'm not going to explain how that I don't think that's for this podcast. Seasonality definitely also came into play too. Just we're entering summer. We talked about that in Q2. Jobs numbers coming in lower. Lots of things, but bottom line, and again, I don't want to spoil this too much, but a lot of times I just like to say, just wait and see. Okay, give yourself a little bit of time. And, again, I'll cover this later, but risk tolerance is a very important aspect of financial planning. So we'll talk about that.
John, you did call the volatility.
I did.
The podcast, he's not going to admit it, so I'm going to say it for him. The podcast came out, and we're not allowed to make predictions or guarantees or all of that fun stuff. We record the podcast. John says, watch out for volatility coming. 1 week later, the markets go crazy. So I'm not saying John's the guy, but I'm going to listen to what you're going to say right now, John. So go ahead.
My crystal ball. What do I say? All right, let's get back to the election. I'm going to tell you who's going to get elected. All right, so one of the other things we like to look at is what's the actual composition of the government. All right, so you've got Democrats, you got Republicans. Who controls the office of the presidency, and who controls Congress? And throughout, well, this chart only goes back to 1947. This one's from Standard & Poor's and J.P. Morgan. But since 1947, 60% of the time we've had a divided government. Right, so president doesn't get to tell Congress exactly what to do. Only 10% of the time were Republicans all in charge, and 30% of the time Democrats were all in charge. And we found GDP, so our gross domestic product, our economy growth, and the returns were actually lowest when it was divided government. Now, this was something that was kind of a surprise to me because I'd always kind of assumed, you get some gridlock and, you're not pushing one far too in one direction. But then I looked a little closer and we had divided government in 2001, 2002, 2008, 2020. So some very bad years for the market and for economic growth. 2020, obviously, the first time we've ever kind of purposely shut down the economy. So, I think it's worth noting, but I don't think it's the cause of why divided government didn't work necessarily as well. Same thing with returns. It was 2000, 2001, 2002, and 2008. Real GDP growth has actually been highest under an all-Democrat government, while the actual returns of the S&P 500 have been highest under a Republican-controlled president and Congress. But what we like to kind of make sure, that doesn't necessarily mean it's the causation of those outcomes. Economic conditions depend on a lot of factors. Global, are we in recessions? When did those form? Interest rates, Fed policy, all that stuff that not necessarily a president or a Congress. I think those things can be we can have effects years on down the road. I don't think all of those can be attributed right off the bat. So I don't think you can really plan an investment plan around that. So I don't.
John, you can blame it on the last guy if it's bad, and you take credit for it if it's good, right?
That's what I try to do. All right. So how many times have you heard this? This is the most important election of our lifetimes, right? It's always the most important election, right? I think in general, and when I hear people say that, to me, it's kind of sets off a little red flag to me that person is probably depending a little bit too much on their emotions if they're using that with investment decisions, right? Investors tend to have biases. There's some other good charts JP Morgan put out. It shows during the presidential terms who thought the economy was doing well and who thought it was doing poorly. And you generally see, okay, if it's a Republican president, then those numbers are going to be way up for Republicans and way down for, they're going in the same direction because you can't really argue with what the stock market and the economy is doing. You're going to be subject to it. But the effects are a lot greater whether or not this is my guy or girl, right?
Yep.
I think, and you've seen it, I'm sure, in meetings. You've definitely seen when someone is way too heavily emotionally invested in a certain person or company or direction of the market. That definitely weighs heavily on their decisions, and we have to sometimes work very hard to talk them off of that, right?
Yeah.
Or at least, let's try to be a little bit, does that, cause this? And usually it doesn't. So what we see actually for money flows and where money is invested the year before an election and the year during election, and we're seeing it right now, money markets have the most monies flowing into them. It's people being concerned. Right now, you might also throw in the fact that money markets have been paying a very good, safe rate. But you generally start to see year one of a new presidential term, year two, money flows out of those and into equity funds at giant proportions. So right now, the latest figure I heard was $6 trillion in money markets. Whether we have an election or not, the Federal Reserve, you got Powell speaking later this week at Jackson Hole. All indications seem to be that we're getting prepped for some interest rate decreases, right? So I'm not going to say foregone conclusion, but September sounds pretty, I wouldn't say in the bag, but probably in the bag. Mm-hmm. So I did say it's in the bag. So interest rates are already generally coming down. I think that's going to put pressure on a lot of people when they start seeing their short-term interest rates on money markets to say, where do we go with this? They might not do. A lot of people are usually behind the curve, and that's one of the reasons why you generally see this type of activity before and then after the election. Again, that's uncertainty is kind of lifted. All right, we can start putting our money into these equity funds. Well, there's some good reasons to not try to time that, right? To just kind of stay invested and not try to think, all right, I'm going to wait till everything looks sunny and clear to start investing when, the people that generally make the most money in the market, the long-term investors, they make their money by investing when things don't look sunny, right?
Yep. So you're probably going to say this is for later, but I have to ask. Money market funds. Sitting in money market funds right now, if I wait to invest that, and let's say I want to keep it safe, and I want to maybe move it into some bond funds, by the time interest rates are cut, is it too late?
Well, I would say probably already seeing start of the pickup in bonds right now.
Mm-hmm.
I would also caution, I don't think anything's ever too late when it comes to investing. Like I've pointed out before, I don't want to try to time and be the first person into something. I usually like to, I was always this way with technology too. I'm not the first adopter. I want to wait to make sure that that's actually, okay, I think the one time it happened to me, I got kind of punished by buying a certain computer that had a processor that was supposed to be the next big thing, and then people weren't actually making apps for that processor. So, no, I'd say it's going to hurt a little bit more if you're dependent on that, and you might be buying in at a little bit levels that might be. But I generally think these types of trends are more long-term trends anyways. Okay. So, no, I don't think you're hurt by waiting. But there is some evidence here that I will get to very shortly that shows why maybe you want to have a more reasonable approach of not just trying to time it out.
Okay.
So here's some mistakes. There's a lot of policy differences between Democrats and Republicans, right? You've got trade, taxes, regulation that would affect mergers and acquisitions, immigration, defense, energy, the independence of the Fed. There's arguments on that. Healthcare. So a lot of times what we hear is, oh, this person is going to be elected, so I want to go into this sector. I think this one, Trump's going to go after healthcare, insurance, all that. But here I'm going to give you kind of a little bit of a case study. And you're a bright guy, so you'll probably... it's going to jump out at you. But I would say, asking most people on the street, they'd probably get this wrong. So if I told you out of the last two presidents, global clean energy index during this presidency was up 275%, which president would you guess?
I know which one you want me to guess.
As I said, you're a bright man.
Trump. But
it was President Trump.
Yeah.
And if you listen to media and all, he's going, he's not about clean energy. He's all about, the typical kind of Republican baseline. But it grew 275%, that stock fund. The actual energy index that's more traditional, oil, gas producers, I'll let you take a guess at what that was during Trump's presidency.
Globally, Obama.
No. Just tell me what you think
what went up.
Trump's was for the energy index as a whole, like
holy cow.
Traditional energy producers.
So the clean energy was 275.
275%.
Flat.
Down 40%.
Flat was way off.
So let's go to the Biden administration. So what do you think the global clean energy index has performed during President Biden's administration?
Oh man, this is awesome because it was already up 275. I'm going to say down 40%, John.
All right, close. Down 50.
All right.
Down 50%. And the actual energy index for the more traditional
and that was down producers, 40, so we're going to go up 100.
Up 200%.
There we go. All right.
So I think if you ask most people what they thought and you put those numbers out there, they're probably going to pick the opposite. And that's why I tell people don't have these biases about what you think.
Yeah.
Right? Have some patience, watch what the actual trends are. Don't go in prejudge. Have an open mind.
Mm-hmm.
I said it on my walk with my dog. Have an open mind. All right. So here's my tips. Just some quick tips. How do you survive this election? 1, avoid that bias trap. Don't have preconceived notions of what you think is going to happen.
It's too late, John. We're not changing anybody's mind right now. Let's keep going.
Okay, try. That's why I said try. Avoid making predictions about the overall market or specific sectors and industries. I just gave you one example. I'm sure I can find more. Wait and see. Diversification. All right. It's preached all the time. It's not just a code word. It really means you want to spread out that risk, right? Because, again, I've talked about this. I think I'm better than most at figuring out which sectors, I want to lean on, but I'm still wrong occasionally, right? So if I look at this stuff every day and I can still make mistakes or be wrong, I don't think there's a good way to say, I need to put all my money in this basket. And I'll go to this one 1,000 times. I've heard this one, the pot stocks. I saw people pouring money in there's legislation, all this, I'm going to invest in cannabis. Well, guess what? You and everybody else had that same thought. So it got to be a very widespread industry. And, it's one of those sell the news type of events. So don't have those preconceived notions. Just diversify, spread out your risk. If there are sectors that do well under the next presidency, S&P, guess what? They're in the S&P 500. They're all in there. So, it's going to counteract there's been a few industries and sectors that have done so well the last year and a half, and there are others that are starting to look better. So it's just a game of diversification, right?
What is the S&P 500?
Oh, we didn't talk about this. S&P 500 is just the largest. It's an index that tracks the largest 500 companies in the United States. All right?
What sectors are in there?
Oh, gosh. So you've got communication services, consumer staples, consumer discretionary, energy, financials, real estate, materials. Did I say healthcare already? Healthcare, industrials. I said materials, technology, utilities. Did I get them all?
I think so. So I'm saying this for a reason. First of all, it's a good clip for us to throw that up there. What is the S&P 500 and what sectors? And off the top of your head, that's great. The other part is when you're choosing certain stocks, a lot of your strategy is to pick from the sectors. And that's why you said, based on the presidency and who's elected, different sectors will perform differently. So you're trying to pick stocks within the S&P 500. So I'm just trying to make it clear to the listener, when you say they're all in the S&P 500, all of those areas are held inside of the S&P 500 with certain stocks. And then you can pick from those stocks that are in that sector, if that makes any sense at all.
Oh yeah, that's correct. I mean, it's basically a diversified mix of companies.
Mm-hmm.
Here's one that I know you talk about a lot on yours. It's definitely in investing. I think more times than not, I'm thinking about those specific investments, those specific sectors, but this pertains to how do we arrive at a good mix of those? And that's, what are your goals? Focus on your goals. I think too many people focus on like these small little decisions where, I don't know, if I get something right, maybe we're outperforming the market by a little bit, but your goals and actually planning that out can mean a lot more than that, right? So if you focus on the things you can control, and that's setting goals and what do I need to do to get there, these little things, the election's a big thing, but to me, I don't do much different when I'm prepping my weekly stuff, knowing there's an election coming up, right?
Right.
I might have some heightened awareness about some certain things, but, focus on your goals. I think you'll worry about this stuff less.
Yeah.
Stay invested, okay? I don't know how to make it more simple. Don't try to time it. Stay invested. Every study I've ever seen about investing in general tells me that being invested through good times and bad has worked out every time so far. Yes, of course, that's history in the past and can't predict.
Yeah.
But I don't know how to make it any more simple. Just stay invested and you should be fine, right? There's actually another one, another chart study that Capital Group put out along with Federal Reserve, some data. And it basically tracked all the 23 election cycles since 1932. It took an investor that invested his $10,000 on January 1st of the election year, so it would have been earlier this year. Another investor that took $1,000 and invested it at the start of each month for 10 months during that election year. And another investor that waited till after the election, January 1st of the following year. Right. So out of those 23 instances, the person, this fictional investor that just stayed invested all $10,000 at the beginning of the year, on average, was up to $15,860 after 4 years. Okay. the consistent contributor, the one that put the 1,000 in each month, he was up to 15,765 and on average throughout those instances. So a little bit less, but still a pretty good. I think we can argue is pretty close. The person that waited, 14,867. So basically about $1,000 less on average than the person that just invested at the beginning of the year. Right. Now, there's different instances. It was on average, it was 14 out of 23 cycles. The best outcome was remaining invested the whole time. 6 out of 23 instances, it was the consistent contributor. And in 3 out of 23, so that person that waited, they won 3 times out of the 23. So the odds are still in your favor to just stay invested and not try to pick, this is the one that everything kind of bucks the trend, right?
It's interesting with the volatility, right? You obviously mentioned volatility during the election year. I would have thought for sure the $1,000 a month would have had more.
Oh, okay. There were definitely times there. The worst outcome only occurred 6 out of 23 times in the person that stayed invested. The worst outcome happened none of the times if you did the dollar cost averaging, once every month. And the worst outcome happened 17 out of 23 times when the person waited to the next year.
Interesting.
So I don't think there's any real benefit to waiting till after the election to invest in the market.
What do you say if my candidate doesn't win, John? I'm taking everything out of the market, moving out of the country.
I think I just convince you not to do that?
What do you say? I have one more that I just got from a client. This is real. Sorry, I told you I wasn't going to ask you more questions during this, but I got to ask you this. I was talking about the Tax Cuts and Job Act and potentially sunsetting after next year and the tax brackets potentially going up. And I said, if Trump wins, that probably has a better chance of not happening. I have no idea, right? We don't know that. If at the time it was Biden, if Biden wins, there's a good chance that it will sunset and there'll be some new tax laws. There's people out there, John, when you say take away the biases, that would literally say, I will happily pay more in taxes than have the other person elected. What do you say to that person? Look at his face. If you're not watching the video, you got to see John's face during this question. It's beautiful.
I was speechless because I'm just kind of in those moments. I'm speechless. I don't know how to equate emotional investing with what I do.
I knew you were going to say this. I knew it.
I would try I said this before. I would try my hardest to get them to see, reasonable explanations for why they shouldn't have that view. But I mean, at the end of the day, it's an investor's money. They can do what they want. They can move. They can do whatever they want, right? I can only try to arm people with knowledge. All right. Fundamentals. Let's get back to the fundamentals. So, when a football team is doing poorly, what do they work on? They work on blocking and tackling, right? So you go back to the fundamentals. You stop worrying about the small minutiae. It's what do we do to be a good team? What do we do to be a good investor? So what do I look at? I'm still looking at revenues, profits, economic growth, labor market, Fed policy, number of things that don't involve which candidate might win in November. Know your limits. So we talked about risk tolerance many times. I probably am beating a dead horse at this point, but I'm going to keep doing it because knowing your risk tolerance, knowing your limit is probably one of the biggest things that can help a financial planner, advisor, professional, anyone that gives you advice cannot do so appropriately if you don't correctly know your risk tolerance. All right. So if volatility before an election, if it keeps you up at night, then absolutely that means you are likely too over-allocated to stocks. I'm not Dave Ramsey. I'm not going to tell everybody be in the S&P 500 index and you'll be fine. Statistics would probably tell you, okay, probably, but human beings have emotions. They make emotional decisions. If you can't prevent yourself from making an emotional decision, then try to mitigate that and what the damage could be. So there are guaranteed income annuities. There are structured products that'll take some downside risk off the table. There's ways to hedge. Start exploring that, but you should have an advisor and you should be talking about that stuff because if you're all in the market, you're much more likely, if volatility really starts picking up more than it just did, and I'm sure you had people already talking about it when we had that dip. stock investing is a risky proposition, but what do I say all the time? When something like that happens, it's a normal market action.
Yeah.
Right. So if you aren't conditioned to realize that that's normal, we need to take the risk down, and that's okay. There's nothing wrong with that.
Yeah. As long as it helps you meet your goal and whatever that goal might be. The tricky part, and this is for the listener, as advisors, we wanted to send out immediate videos, newsletters, emails. Is everything okay? But it's interesting because 95% of the people aren't paying attention. So if we send a video and an email and a newsletter, we are now forcing those folks to panic when they otherwise would not have even noticed. And 3 weeks later, their accounts were back to where they were before anyway. So it's always interesting when there's volatility like that and how advisors will handle it.
Oh, yeah.
But how much did the S&P drop during that? Was it?
I don't know the exact amount. I think we had gone from about, I think the S&P might have been up about 19% for the year, and it got down to about 10.
Yeah. So it's a quick drop, and it has since basically come back. So if we send out all these alarming emails and videos, so it goes back to anchoring it to your goal. Anchoring to the goal, try not to pay attention, and know that it's handled as long as you're working with somebody that actually is paying attention and you feel comfortable with.
And to your point, as advisors, like I feel like when we do our job really well, we've definitely conditioned our client to know what to expect and to really focus on that. So, we don't maybe get as many as what you might hear, but if you watch TV, it's markets in chaos, all that stuff when you just have a 5% pullback in the S&P 500 or 10%. Like, those happen.
When it was already up 18 or 19%.
Right.
So you lose 5. Big deal. It's the news channels looking for some material. It's funny, at the very start of COVID, talk about panic, right? Like there was no avoiding the panic in the markets at that point.
No doubt.
We sent a quick video. Hey, if you need us, we're here. Obviously, I literally have nothing else to do. Call me if you need anything. But I think that video, anytime the market has dropped, I've had clients reference back to that and say, I remember what you said at the beginning of COVID, and I just trust that you guys know what you're doing. So people have been conditioned is my point.
Yeah, I remember there was one I sent out. It was like, the title was like, hands off your face, hands off your stocks. Something basically with the notion of, just try not to do anything.
The beginning of John's investment career right there. Hands off your face.
I remember that to this day. All right, so here's my 5-step how to survive the election. If you paid attention to nothing else in this entire podcast, I know it took a while to get here, but step 1, leave your emotions at the door. All right. Okay, you're a human being. You can't do that. I get it. You're not a robot. So most people I know can't do that. So let's go to number 2. Meet with a financial planner and focus on your goals. So we talked about that a little bit, but bring the goals back into focus. Stop worrying about the little things that you have no control over. Step 3, make sure your investments properly match your risk tolerance. All right. If I haven't been clear enough, just get your risk tolerance under control. Step 4, this would be cutting or reducing the amount of garbage you put into that brain. And that's I like to watch certain news channel. What's a news channel designed to do? All right. If you are someone that likes to watch news for 3 hours a night, try to reduce that down. Try to take it to 2 hours a night, maybe 1. Anything you're watching from like the hours of 7 to that. I told this to clients a lot back then. I watch financial news a lot, and you're going to find this news wherever you go, like social media, whatever. News will find very important news will definitely find you. But the stuff that's intended from the hours of 7 to 10, it's intended to condition you to react in a certain way. And most of that filters into a phone call I get. John, I heard this guy's bombing this one. Or should we pull all our money out of the market? Stop watching that. Or again, reduce it. If you're 5 nights a week, take it down to 4. Whatever you need to do to try to find some unbiased stuff out there. There's a lot, what do I read around this election? I went to all these fund company sites, and of course they have an interest in getting you to invest, right? Mm-hmm. So they're never going to but they're just looking at broad statistics and history of the market and what's been a good decision to do. All right. Do you want someone on TV telling you, the market, this guy's going to make the market tank? I hear that all the time too. The market's going to tank. It hasn't. I don't think it will based on an election. Again, focus on that other stuff that does matter, but reduce that down just a little bit. Number 5. All right. So this was my last video, walking with my dog. Find out what helps you relax. Just relax. Turn it off. Try not to pay attention. Do your regular meetings. Call your financial planner, advisor. They will talk to you. They'll get an extra meeting. I know, like we've said it many times, client can have some concerns, and a lot of times they just need that reinforcement that what we're doing is okay, right? So just go take a walk. Go sit by the river in Pittsford, feed some ducks. Whatever it is that gives you that relaxation, write that down. That could be a goal. If you don't have something that helps you relax, go find something that helps you relax.
I'm getting you a t-shirt that says Feed the Ducks 2024.
So that's basically it. I don't want to, kind of dwell on statistics and facts and all that. I think my big picture messages would, I just said it. Don't dwell on the news. Try not to make emotional based decisions. Run that by somebody first that has your interests at heart. Good financial plan. Those are stress tested to involve presidential elections and recessions and global financial crisis. All that stuff that we do in a financial plan gives us an idea whether or not you, based off of your savings, can spend X amount of dollars for X amount of years and probably be okay, right? We get these gauges of what your probability is. That's something you should be focusing on. Don't worry about the other stuff.
I love when John Harms gets fired up. Stop watching the news, folks. Actually, John, 3 hours. What's the math on that? If you cut it by 15 minutes a week from now to the election, by the time the election comes around, you'd be down to what? What is that, 30 minutes? So we gone from 3 hours to 30 minutes. John Harms just saved you 2.5 hours every single day, folks.
Trying to make the world a better place.
John, appreciate the time again. It's 37 minutes in. We'll end this there. We're going to have you back on for the Q3 update. It'll be right after the election, so we'll see what chaos is ensuing at that point.
This was my pleasure. Thanks for having me back. Looking forward to the next time.
Yeah, you got it, folks. Make it a great day.
Intent here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. All investing involves risk, including loss of principal. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. Information here is provided, in part, by third-party sources. These sources are generally deemed to be reliable. However, neither SixPoint Financial Partners, Private Client Services, nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of SixPoint Financial Partners. They do not necessarily represent those of Private Client Services, RFG Advisory, their employees, or their clients. This commentary should not be regarded as a description of advisory services provided by SixPoint Financial Partners or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives through Private Client Services, member FINRA, SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, LLC, RFG Advisory, or RFG, a registered investment advisor. Private Client Services, SixPoint Financial Partners, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure.